Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
This is like a late night version of Wilmington Mortgage. What can I say? It was a busy day. I got nothing else. But we do have a lot to get to. And as always, give you an idea of what's happening with rates in 15 minutes or less, no matter what time of the day it is. But welcome everyone, of course, to Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer at Town Bank Mortgage, right here in Wilmington, North Carolina, hence Wilmington Mortgage. And as I said, let you know what's happening every day with rates in 15 minutes or less. And today's actually pretty easy. So we had another slight uptick in the 10-year. 10-year yield, of course, influences the 30-year fixed. Slight uptick. Why? Well, first of all, we've been like on a slow kind of uptick for the last couple of days. We're now at the second highest level. That would be the 10 years. So, mortgage rates kind of track. Second highest level since the beginning of October. So we're kind of on a little bit of an upward trend. And what really has been kind of the catalyst for this is the uncertainty about what's going to happen at the meeting in December with the Federal Open Market Committee, the Federal Reserve's kind of committee that makes the decision about the Fed funds rate, which controls interest rates and indirectly impacts the 30-year fixed. And as we all know, for the last couple of months, it's been sort of assumed that we were going to see 3 rate cuts this year. So we got one in September, we got one in October, and everyone's like, of course, we're going to get one in December. And it looks like we might not be getting one in December. So everyone now is kind of recalibrating their projection for what's going to be happening. And that was once again sort of echoed in the minutes that were released. So these are the minutes from the October meeting. And once again, the divide between the committee members was apparent. So 3 main things are going to impact this. We have inflation, we have economic growth, and the labor market. Now, the Fed has a dual mandate, which is inflation and labor market. Economic growth plays a part in that because obviously, when economic growth is exploding, you're going to see higher inflation more than likely. When economic growth is slowing, you should be seeing less inflation. And then vice versa with the labor market. Or I should say kind of the same thing with the labor market. When the economy is exploding, the labor market should be tight. When the economy is slowing, the labor market should be kind of loose or weak. And that's sort of the problem is everyone's trying to decide what is the bigger issue. So obviously, inflation has always been the biggest issue. It's the biggest issue for bond investors. It used to be the only issue for the Fed. And so it is the most important issue. There's no doubt about that. And so where do they stand on inflation? So the Fed staff, noted in the minutes, during the meeting, that the price pressures have not eased as some were hoping. They said, quote, consumer price inflation had moved up since earlier in the year and remained somewhat elevated. Total PCE, of course, that's the Fed's preferred inflation gauge, not CPI. Total PCE inflation was running roughly 0.5 percentage points hotter than 1 year ago, while core PCE was flat, unchanged from last year's pace. So that's somewhat good because, obviously core inflation is a bigger matter than when you include food and energy, which are more volatile items. However, FOMC participants echoed those concerns about overall inflation, saying, quote, they had been above target for some time, meaning inflation, and had shown little sign of returning sustainability to the 2% objective. So what they're concerned about is that they were hoping to see some relief at that point. Now, of course, remember, in the October meeting, the shutdown had been going on for about a month, so we had not gotten any data. So they were relying on a lot of private sector data, a lot of kind of estimates out there. but not the sort of rock solid government data that they use to make their decisions. FOE participants, or I should say several, pointed to stubborn core non-housing service inflation as the piece most likely to keep prices above 2% into early 2026. This is important because one of the main arguments for, hey, inflation really isn't that bad, has been housing inflation, which, as we all know, of course, the higher home prices had been sort of stuck at that level, no real relief. And so it was creating this environment where you were seeing higher, rent prices, higher home prices, and that was keeping inflation higher. They're not mentioning that anymore. This is non-housing service inflation. And then with the concern of maybe a certain rise of goods inflation, maybe on the horizon with regards to tariffs, that's one of the reasons why you're seeing some hesitancy from some members about this idea that, oh, don't worry, inflation is eventually going to get back to 2%. That's one of the things they're concerned about. So inflation is always the most important issue, and here they're showing concern. Now, on the other side of the ledger, we have economic growth. Despite a strong rebound in the second quarter, staff warned that GDP growth in the first half of the year lagged the 2024 pace, which wasn't really that great to begin with, underscoring a moderation in overall economic momentum. And then, of course, we've heard comments from people like Kevin Hassett, who have mentioned that because of the economic shutdown, or I should say the government shutdown, the impact on the economic data could be that we see possibly a negative print in the fourth quarter. So we could see depressed economic growth. Once again, that's a good reason to cut rates to stimulate the economy. So we're seeing stickier inflation, bad. That's bad for cuts. That means they're not going to cut. And then on the other side, we're seeing not so great economic growth. Also on that side of the ledger, labor market. Participants highlighted that before the government shutdown, job gains had slowed meaningfully and unemployment had edged higher, though still historically low. The softening has added urgency for policymakers wary of over-tightening into weakness. So you got two camps. You got people who are worried about the labor market and economic growth, and then the other side is worried about inflation. And so if you're someone who's like, the labor market's a problem, economic growth is a problem, we have to cut rates, that's what they're arguing. And you have people who are worried about inflation saying, I don't think we should cut rates because inflation is already well above target. Cutting would not be good. And so this is where the disagreement comes in. Many participants think the Fed should hold steady for the rest of 2025, warning that inflation remains too sticky to justify another near-term cut. Several said a December cut could, quote, well be appropriate if incoming data lands in line with their expectations. So if we do start to see some movement in inflation going, downward, that would be a sign, hey, we are maybe breaking this mold. Some explicitly argued they do not see another 25 basis point cut as appropriate at the upcoming meeting. So that's one of the reasons why we've been seeing rates trending higher over the last few weeks. This uncertain, it's been a while since we have gone into a meeting kind of not knowing what's going to happen. And we're still a couple weeks off, but it doesn't seem like we're getting any closer to really having an idea of what's going to be happening at the next meeting. And in fact, I'm going to pull this up real quick. I should have had this ready to go. The Fed Watch tool, once again, now we're at 67% chance they hold rates. So a month ago, 6% chance. 6% chance they were going to hold rates. 94% chance cut. Now we're at a 67% chance rates are going to hold. That's why we're seeing rates trend higher into the end of the year. And once again, mortgage rates are up a little bit, but it's nothing disastrous. It's not like, oh my gosh, we're back to 7% again. We're just seeing, back a couple weeks ago, we were between 6 and 6.25, and now we're, 6.25 and 6.5. So, it's nothing that's really going to put a dent in anyone's possibility of buying, but it is a sign that we are on kind of an upward trend at the moment. I mentioned tariffs earlier. I do want to get into this interesting poll that just came out. So we all know, of course, President Trump recently, to help consumers, announced that they were going to be removing tariffs from certain products to provide some price relief for people and, not seeing such a high bill when they go to the grocery store. And a new poll from The Economist and YouGov is saying, you know what, that was probably the right decision, because this is crazy. Nearly 3/4 of Americans, 73% of Americans say tariffs have increased the prices they pay, with 40% saying a lot, 33% saying slightly. Now, I know what you're thinking. Oh, well, maybe this was a heavy Democrat poll or something along those lines. This is bipartisan. Now, obviously, Democrats are much less supportive of tariffs. 92% of Democrats say tariffs raise prices. However, 72% of independents, 72%, 56% of Republicans say tariffs raise prices. So it's pretty obvious. Now, if we want to get into a deeper discussion about, well, of course, prices are going to rise, but in the long run, it's going to be good for manufacturing or, agriculture, whatever it is that we're trying to help or protect. That they didn't ask that. They just said, hey, the tariffs raise prices. And, we've heard people in the Trump administration say, oh, no, prices don't rise. And American people think they do. That's the point. The American people think the tariffs cause price hikes. And then there's been a lot of hostility towards global trade, really since kind of Trump got into politics in 2015. That was his big argument. NAFTA was a bad decision. He ran back in 2015 and 16 on TPP. He was not going to allow that to move forward, so much so that it eventually led to Hillary Clinton, his opponent at the time, who had been a supporter of TPP. That was the Trans-Pacific Partnership that would have been a deal in that region of the world, to also pull out of that deal. And so there's been a lot of hostility about global trade and the impact that it's had. And here's what's interesting to me. 55%, a majority, 55% say foreign trade makes the average American better off. Just 15% think it makes people worse off. Obviously, the middle is people don't think it has any impact. So all of this hostility that you see online, that you see everywhere else, still a majority of people think that foreign trade is a good thing for us, good thing for the American consumer. Now, once again, we could do a deep dive and say, oh, well, do you think that's hurting some workers? And, that's different. But at the top level, overall, sort of looking at the aggregate, is global trade a good thing for the American consumer, for the American people? 55% still say yes. And only 15% say worse. So sure, 55% is just a little bit of majority, but it's not like, oh, the other 45% are saying absolutely it's bad. Only 15% say it's bad. So like I said, there's a lot of hostility online. A lot of people don't like trade that we're seeing out there. But they seem to be a vocal minority, a very vocal minority. Only 15%. Also, it was noted when asked about the direction of U.S. trade policy, Americans prefer increasing trade, 42%, not a majority. Plurality, 42%, but only 11% were in support of decreasing it. So once again, that kind of middle level saying, no increase, but still 42% to 11, 4-1, almost 4-1. Interesting. So Trump probably made a good move by knocking off some of those tariffs, because people are like, yeah, that's causing the price hikes. So once again, rates are up a little bit because of the uncertainty about the December FOMC meeting. These FOMC minutes from October gave us no guidance. Still a lot of confusion, up for debate. But if you want to know why rates are up, there's your answer. And we got to go. My 15 minutes are almost up. You guys enjoy the little bit of Wednesday that's left. Enjoy your Thursday. We'll talk to you Thursday afternoon for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.